Let's dig into these numbers with Ed Lee, media reporter at the New York Times, and Bernie McTernan, internet and media analyst from Rosenblatt Securities. Bernie has a neutral rating on Netflix's stock, which is now surging, Bernie, more than 8%. Whether it's the cash flow neutral headline, the better subscribers numbers, what's your initial takeaway?
Yeah, I think it's the cash flow neutral. And so what Alex was talking about before, no longer needing external financing, break even in free cash flow in 2021. Remember, the commentary from the prior quarter was, I believe, negative $1 billion to break even. So now just break even. So that's a better guide there. And then they're also increasing their operating margin guide for 21. It was 19% established in the prior earnings call. Now it's 20%. So, I think all those are pointing to, the sustainable free cash flow profile of the business. And then subscriber ads a little bit better than expected for 4Q, a little bit lighter for 1Q. And I think that's what you're seeing from the stock here. It's been, lagging the other FANG names down about 6% over the last 3 months. So, a bit of catching up.
Ed Lee, your top line thoughts?
I think the cash flow is really the story here. The fact that they basically say they're not going to go to the bond market anymore to borrow any more money, that they're going to be self-funding going forward. Finally a real company, so to speak. Reed Hastings had actually been telegraphing that a few quarters ago anyway. So in that way, it's not a huge surprise, but it shows that finally they're at the subscriber level where the money coming in will actually, fund this massive content slate that they have and that they continue to spend every year. So I think it's a signal to the other streamers as well. If you're Disney Plus, if you're HBO Max, you're looking at these numbers thinking man, I need to be at 200 million plus before I'm really at a true break even standpoint. So it's a positive for Netflix. I think the strength of their balance sheet, also the fact that they're talking about stock buybacks, which they had done years before, but that they're doing now is, again, sort of more underlying confidence in their cash flow. And I think that's what's bumping up the stock here. The 6 million forecast for this quarter is soft, right? And I'm wondering now whether how much of that was sort of normalization, meaning the pull forward from the coronavirus from last year versus competition from Disney Plus and HBO Max. And I actually think it's more of the latter. I think they're seeing the competition. I think they're seeing, more sort of switching. Consumers are sort of turning on the service, canceling it for a month after they've seen what they want to see, and then they'll pay for a different service. Deloitte had a study out this morning that sort of showed that there's a rise in that kind of activity. And I think, it's going to be harder going forward for Netflix. But again, finally, they're now at the level at which they're self-funding, that they've got enough cash to do both paying back their debt and spending big on content.
Yeah, but on net ads, I guess Q4 plus Q1 forecast in line with expectations. So whether they've pulled it forward just to this quarter rather than for the maybe years ahead. Bernie, just want to come back to you. I mean, clearly being cash flow positive is a great moment for them. But once you get there, and it's only just getting there, should they be buying back stock already? I mean, maybe it's grown into its valuation a little bit over the last 6 months, but this isn't like a bank and a 7 times PE company, which is sort of not X-growth, but to say to the banks, but it's sort of saying, are stocks cheap? I mean, I don't quite understand why you'd be suddenly, the day you turn cash positive, talking about buying back stock.
Yeah, no, it's a good point. And really, it's interesting kind of the valuation change that's going on with the company. So it used to always be, EV to revenue, and that's really what mattered. It was a sub top line story. And the company is transitioning to being a free cash flow and earnings story. Will be interesting to see how they can do it, because as you mentioned, when you're generating free cash flow, all of a sudden, well, now you're being valued on that, so that multiple is that much higher. The investors that we speak to are talking about $30 of earnings a few years out and putting a 30 times multiple on that. What really matters is how much they need to spend on content to drive the subscriber growth in the future, because being self-funding is fine, but now you have to generate a lot of free cash flow if you want to justify this kind of market cap. So when you have Disney Plus at their investor day talking about spending $16 to $18 billion on content in 2024, really, we think that there's just a lot of upside risk to Netflix here in terms of, cash spend going from 15 to 20, and then, does that have to go to 30 billion over time, or, 25 billion? billion. Really, the stakes are really high with a company like Disney who's all in, and we think it's going to push Netflix to spend higher and make it that much harder for traditional media companies to compete.
Shepard Smith here. Thanks for watching CNBC on YouTube.